favorite financial podcast, The Lens. This week, Craig and Larry are back to tell you everything that happened this week, everything that we're seeing at the Bird Traps report, everything that our contributors are telling us on our Bloomberg Live chat and on our Discord chat. Guys, go ahead. But before, we're back in the top 10 thanks to you guys. Go ahead.
Thank you, Valentina. And yeah, we're really proud of the book, How to Listen to Markets Speak. The whole second half of the book is about the move from financial assets to hard assets. The copper names, the XME, the COPX, dramatically outperforming technology this year. The entire street is focused on artificial intelligence. They're upgrading NVIDIA every day, but nobody has a lens on the energy picture. No one's connecting the dots. We're going to get into some things. Craig, let's just get off. This has been a crazy day. You've been talking to institutional investors in our chat. What have people been saying about China and vol has been kind of pumped into this. So what's going on?
Yeah, it's been a weird week. It's been a quiet week, but an active week, and then boom, about an hour ago, it became a little bit more hectic. Right, we started off the week with a big surprise in Japan with the elections there that led to a decent move, stronger in the dollar and dollar yen. So some FX volatility started. We had a massive run up in precious metals all week, which reversed yesterday. So
metals were up with the dollar.
Metals were up with the dollar, and then we saw a reversal yesterday. So we saw some volatility back in precious metals. Then this morning, oil started to really break down from the trading range it's been in, maybe on back of some of the peace talks in the Middle East.
And people are saying oil and rates together. What's happening there?
Yeah, so oil, less inflation, less of a burden on the Fed, maybe some indicative of some slowness in the economy globally. So bonds had rallied, yields lower alongside oil. So a lot going on this week, but under the hood, equity volatility had been grinding higher for most of the week. We saw, I think there was a stretch there with 5 days in a row where we had the VIX up and equities up, which I think is never happened before.
16 handled VIX with the market at all-time highs.
Yeah. So it's been a weird week, right? Where we started to see some cracks in volatility or some bids in volatility on a cross asset basis, but equities have been making all-time highs, and then again this morning. But notably this morning, it was in a couple of conversations where people have been talking about volatility for some deep out of the money puts being quite elevated for really no reason. And typically what the zero data expiry crowd does is they go in and sell volatility every day. And so it was notable that some of the vol had been bid. And so
look, explain that. So they're selling vol. And someone pointed out to you that there was a mysterious
it was strange that some vol for today seemed to be mispriced, seemed to be much more bid than you would normally expect for some deep out of the money puts.
And this is before the Trump headline.
This was before the Trump headline. This is right at the open and for the first hour of trading. And so look, I mean, it wouldn't surprise me if some people had advanced word.
Who had dinner with Trump last night?
Yeah, look, I mean, the stuff coming out of China on rare earths, we've known for quite some time. China is using rare earths as a tool to help dictate trade terms and dictate geopolitical terms. And so its ability to dial up and dial down exposure globally and availability of rare earths, China uses now to its own advantage. And so earlier this week, they came out with a much larger list of export controls regarding where rare earths can be sold to. And so I'm not sure that it should have been such a surprise that China's not really going to look to sell rare earths to the U.S. military for weapons, right? We're in more of a global hot war in some areas with China. And so the fact that they're not going to be selling us rare earths to restock our military kind of makes sense. But it seemed like some of the export controls were a little bit more aggressive and went beyond just rare earths. And so Trump was asked about this yesterday at his press conference, pretended like he didn't know, or maybe he wasn't, maybe he didn't know. I don't exactly know. But clearly he learned enough from yesterday afternoon to this morning to put out a pretty lengthy, looked like a 2,000 word or so tweet, very aggressively coming back at China and saying, look, if this is the game you want to play, we could play it too. We could ratchet up sanctions. We could ratchet up tariffs. It seemed like he tried to, still put a little bit of an olive branch out there. Doesn't want to move into a full protracted trade war again, which is what we had in the first week of April, because he knows what that might mean for markets. But look, he suggested that potentially the meeting with Xi in Korea later this month will be off the table now, and so markets reacted pretty violently for the first time.
So Craig, in our book, How to Listen Markets Speak, there's a chapter on national security and rare earths and critical minerals, critical materials. The United States is at a big disadvantage. The White House is panicking. Some of our people in the chat, big buy-side accounts, are talking about real national security problems around defense. The ability to make certain weapons depends on those critical materials, critical minerals, and rare earths. China and Russia have outflanked the United States for a decade, while Republicans and Democrats are disagreeing. They have different power shifts from Biden to Trump. The White House is in a corner here. Okay, literally, there's a whole mention of this in the book about MP materials. We recommended a lot of these REMX ETF, which is the rare earths ETF. It's on fire this year, all in the book, and it's all because of national security on critical minerals. And Craig, the other thing that's been happening this week is everyone knows about the tricolor auto finance situation and First Brands and this whole toxic for private credit. I mean, this is a toxic cesspool. When you don't allow the business cycle to function over longer and longer and longer periods of time, you literally are placing Bernie Madoffs on street corners in the United States. The lending standards in private credit are disgusting. The Financial Times has been out in front of this. CLO managers were buying private credit loans over the last year without even doing any homework because they were forced to put money to work. This is one of the dumbest investments in the history of capital markets, is some of this private credit garbage. And you just see here, Apollo. It's very interesting that private equity and private credit players are so weak, with the market at all-time highs. And that's one thing. And you've got this whole forbearance situation, Craig, with student loans where the Biden team forgave, I guess you had like a period of time where you didn't have to pay your student loan payments. Now that's coming back on, and that's basically contagion over to autos. And I think that's the bigger thing under the surface this week, was this kind of contagion. And we'll get into it, even high yield started to look at the HYG versus the S&P really rolled over, and high yield's been outperforming as equities have gone higher. This week, there was some contagion from the credit space and private credit, private equity over to high yield for the first time.
Yeah, I mean, we've been talking about it in the chat for a few weeks now, and mentioned it here on prior podcasts. But we talked about some of the pain not just being tied to the tertiary financial areas and starting to become broader out. Names in student loans, like you mentioned, Sally Mae and Navi and SoFi, some of the auto loan lenders, buy now, pay later, these business development core weaknesses, subprime, and now private credit. Right? It's growing in size as far as where the credit strain is being observed. And not surprisingly, it was first seen in some of the low end consumer related and parts of the lower part of the K-shaped economy, but now seems to be broadening out into some of the last in first out tech lenders, into AI. And so look, are we going to have a full-fledged massive credit problem that burns in the next 6 to 12 months? Unknown, but we're definitely starting to see the signs of this picking up and accelerating here, and massive divergence between the AI stuff making all-time highs and some of these financials and regional banks and some of the U.S. sensitive names in transport and retail, not following along. And so the breadth and the rally that people were hopeful for doesn't appear to be materializing. It seems like we're moving back the other way again.
Yeah, and you can see when you get a 9% move down in Citibank in like 2 weeks, that means something. You get a weekly MACD there. You've got a kind of bearish signal there, bear hammer fully engulfing there last week, that top right corner Let's move forward on the slides. But yeah, so we're looking for that contagion from private credit, private equities in the week over toward the larger financials, auto loans, student loans, and you want to keep an eye on things like Capital One, and then here you go, auto lending. So Ally Financial dramatically underperforming the market and the rest of the financials. So there's definitely been this contagion moving from kind of, and we saw this in 2007. It's not the same. It's not a Lehman situation, but there's definitely a contagion moving forward. And you can see here that is, yes, this, you were talking about Sally Mae. Like, yeah, 20-25% move down in Sally Mae in a couple of weeks, while the XLF is making new highs. You know what I mean? So there's a contagion there. So we're trying to listen when markets speak. We're listening to Sally Mae. Blue Owl, this is something that people are talking about. Think of all the money that's coming into capital expenditures and artificial intelligence, Craig, right? Blue Owl is a big lender into software. And the software names like Adobe down 50% on the public side. So it's a public equity. So if a public equity like Adobe is down 50%, what do you think's happening to triple C like loans and private credit in the technology space, software? That's Blue Owl is a software lender. That's telling you there's a big. I literally think this could be. I think it's $100 billion of private credit loans just in software alone, right? Those potentially are zeros.
Yeah, it's not clear why people felt the need to stretch into these areas, given how well the equities have been doing in the Mag sevens. But I guess it's that classic, I can't buy that thing that's at the all time highs. Let me buy some second derivative, third derivative with some yield cushion. But spreads, credit spreads, just too tight, right? We've been talking about credit spreads being too tight for months now.
But really that's right on IGs, right? But now look at
yeah, no, I'm saying until the last 6 weeks or so. But it's so you had this chase, right? This scramble for additional yield, and now you have this kind of last in, first out dynamic where these loans that were made in the last 6 to 12 months really are we're done without standards, poor underwriting, and are really starting to get really get hammered really quickly.
Yeah. Now this is the European Leveraged Loan Index. I would say it's being affected by chemicals in Europe and the French political problem. But the U.S. loan index looks a lot like this. It's not as bad because of the French political dynamic. But yeah, so the investment grade bonds are at all-time highs. We're definitely seeing loans and high yields starting to crack. So there's definitely been a credit contagion over the last 3-4 weeks before the headlines today that came from Trump. Yeah, it's this was as of a couple days ago. That's even up higher. So if you look at how the high yield market, Craig, is wider than July, right? So that line goes on. So and that's a couple days old. So we're even wider now. So the high yield market is we're way off of the tights. This is junk bonds, and we're wider, even though equities are up 9% since July, 9%, the S&P. And the high yield market is not confirming that price action.
Right.
Next one. And Craig, so in terms of your conversations this week, tell us what you've been doing. You've been working with the different buy side clients, the family offices. People are talking about consumer confidence at Lehman levels. So, what's going on there in this chart?
Yeah, look, I think this is indicative of this K-shaped economy that we've been talking about for months, and more people have been talking about, right? Which is the low-end consumer continues to struggle, with higher inflation and deteriorating labor prospects, whether cyclically in a slowdown or even structurally because of AI and what that might mean for labor. So, confidence has been poor, but inflation expectations, I don't know if you have that chart, continue to run, well above normal, well above 2%. And so, a stagflationary environment here for a large swath of the U.S. population has been a concern. But in the chat, people have noticed that, but equities keep making all-time highs, and so people have been very comfortable kind of trading away from some of those areas that have headwinds and focusing more on the areas of strength, whether it be AI or the AI capex build out, or lately in some of the materials related to the AI capex build out. But what we've been noticing, more recently is that, the systematic flows that have come into the market have been massive, right? And so it's the vol selling, this vol suppression that's been going on for months now has led to enormous systematic re-leveraging and leveraging of portfolios. And so, it's been seeing very elevated long exposure for CTAs, for vol control funds, and the like. And so that's been and for leverage ETFs. And so that's been driving the daily activity, which is why the overall indexes remain close to the highs, but under the hood, there's been these negative divergences. And so now if you have a situation where volatility is being reintroduced, some of that exposure needs to come down, because volatility is the throttle by which these guys make investments. And so if the VIX and if realized vol start to pick up, there's going to be forced systematic deleveraging that goes on. And so all the headwinds that we've been talking about fundamentally may actually now start to matter when you start to get some of this systematic and passive selling begins.
Right. And one of the clients pointed out to us, this is really interesting. Your Brent versus gold is at COVID levels. Okay. So we've had a large position in the gold miners in our high conviction portfolio. We've cut that down by 40%, and we're moving into energy. It's out of favor, especially in the fourth quarter with tax loss selling. You're going to get a great buying opportunity. But if you can get long energy equities, whether it be natural gas or oil names, with the Brent versus gold chart here at COVID levels, anybody that backed up the truck on energy in 2020 made, basically 200% in short order. So it's not quite that kind of opportunity, but fourth quarter tax loss selling, we love that now. And then here, you look here, the metals, right? Metals, hard assets. We sold our XME today in the trade alerts. Anybody that wants to be in our trade alerts, info at thebeartrapsreport.com. But we exited XME today. We've been in it for 3-4 years. But it's the most overbought versus the Qs all time. And that's what have people been saying here? This is a lot of the critical mineral companies that are in the XME that's driving this.
Yeah, look, I mean, I think that's been part of it, the MPs and some of the smaller names which have gone up, materially. But gold and gold miners have done incredibly well. Silver miners, and now more recently, palladium and platinum and copper. Everything is kind of, moving in unison here. So XME has really, been that second derivative trade that's benefited from this AI CapEx build out. It's benefited from this idea that we'll need duplicative supply chains as we compete with China. And it's also benefited from this fiat debasement trade that people have been growing increasingly fond of, right? As is concern about global deficits, whether they be in the US or Japan or Europe, or China spending 10% of GDP in deficits. And so there's a broad fiat debasement story that's been going on.
Yeah, it bothers me when Wall Street is singing the same tune around currency debasement, right? They weren't talking about this last year.
We've been talking about this for months, if not years, at every one of these meetings and every one of your weekly reports. And so, to hear it become kind of front page and to see Jim Cramer talk about, how great gold is with gold over 4,000, it just shows you that it's in the price, right? It doesn't mean it's not right. It just means it's in the price. And so to get some digestion here, I don't think would be too much of a surprise.
And you know what? We have been taking down gold exposure, adding to silver, platinum, palladium all year. And you got to look here. I mean, in a normal commodity bull market, this gold silver ratio should be, in the 50s, right? But it's still up. I mean, we broke the uptrend there, but you're still in the 80s, high 70s. And that's pretty crazy. And then that gets back to what you're saying. One of the guys said in the chat, he's like, Wall Street's coming up with all these narratives. It's just China buying gold in size, right? In size. That's been going on, but that's the primary driver, and that's one of the things why gold is so expensive relative to silver. And then you can see the platinum and palladium buying this high conviction trade alerts all the last 6-9 months, starting to lighten here. Because remember, platinum and palladium, the entire market, $340 billion, right? 300. It's a rounding error. I mean, NVIDIA is 4.6 trillion, and platinum, palladium, well, just the market cap of gold, well, the gold's now up to 22 trillion, 24 trillion, something like that. So platinum and palladium, $360 billion market. It doesn't take much to really move what we call the platinum group metal space. And here you can see the China purchases on the gold side, and that's creating those distortions of gold versus silver.
Yeah, I think the gold story continues to remain, very strong thematically, structurally, but tactically, it's harder now, right? And so I think you've done a good job in downsizing some exposure, rotating some exposure, and we'll be looking for pullbacks in gold because, look, the truth of the matter is we know that the administration is unlikely to tolerate any growth slowdown. It's unlikely to tolerate a significant market correction, and it will respond to either of those things with more liquidity to the extent that it can. And a weaker dollar is part of what the administration is trying to do here. And the world knows it. So we continue to diversify, or globally, central banks and foreigners continue to diversify out of treasuries into gold. And that's a thematic that's likely to stick with us for the next several quarters.
And now there was an announcement this morning that we're going to get CPI, I think in
2 weeks. I think that's interesting.
What do you think about commodities versus CPI? Look at that BCom impact on CPI.
Yeah, look, I mean, it's there's definitely been underlying positive momentum in CPI despite the oil move, which has been weak. And so the tariff move is part of that. And this is just the broad commodities index and favorable correlation to overall CPI. The government needs to get the CPI information out because it needs to do cost of living adjustments for Social Security payments. Those are done at the end of September, and so they need to deliver the September CPI print in order to deliver these COLA adjustments for Social Security. That's why it's of paramount importance that the government is doing this. I don't think they're going to do it to dictate a number that is favorable to the administration or worse. I think they just actually have to get the number out because otherwise Social Security payments and knowledge won't be known. So this is important information from that perspective.
And Craig, people have to understand, right? There's not one human being on the planet Earth that's long French long-term bonds, US long-term bonds, Japan, UK. Since 2022, duration is lost money. So all of that capital, each day, each week, each month, that people are losing money in longer dated bonds, those 30 years, that's what's driving this dollar situation. Like, so in other words, you've got this weakness in the U.S. economy, but with the strengthening dollar, and it's because it's not just the dirty. It's the problems in France. It's the problems in the UK. We've got really bad fiscal problems in France and the UK at the same time, and that's what's moving money into hard assets. And that duration, all of those investors globally in those for long-term French bonds, those 30-year French bonds, those 30-year UK bonds. Now we have a big fiscal situation coming into Japan with new government. I mean, that's the hard asset driver. And what's weird is hard assets are rallying with this move in the dollar.
Yeah, look, I think the dollar strength over the course of this week and let's say the last 2 weeks certainly echoes some of that concern and accelerated after the Japanese elections. But I think it's also indicative of this growing credit contagion issue that we've pointed out earlier, which is collateral values starting to come down, a bit of a scramble for dollars, positioning is the other way. And how many times have we seen these dollar rallies, kick off, risk off episodes as the world delevers and kind of scrambles for dollars? I don't think we're out of that stage yet. We still, most of the world still runs on dollars, even as the world tries to diversify away. Most of the debt globally is still dollar based. And so countries and companies are still scrambling for dollars here. That move higher in dollar, could lead to more risk off.
Right. And that's why, we're Bitcoin fans. People think we're Bitcoin bears. We're not. There's just a time to buy Bitcoin. There's a time to buy gold. What I like to look at is this has been work for like the last 5 years. When that Bitcoin gold ratio gets up near 35, 36, it just makes sense to take down your Bitcoin and move into, say, gold, silver, platinum, palladium. But when you get that ratio into the 20s or teens, it's always been a great buy. It's kind of like, that period of where, there's just too much hot money in the Bitcoin situation now, too many tourists. When you go risk off, that's why you've had 70% drawdowns, because there's too many tourists, right? There's not enough liquidity. But what are you thinking about Bitcoin here versus gold?
Yeah, look, I think both here are exposed a little bit here to a dollar rally and to some liquidity coming off, and then I think both will, would work again when liquidity needs to come back in after the markets kind of digest itself a little bit. So the fact that countries are buying countries are buying gold and individuals buy Bitcoin, I think suggests that gold's is probably going to continue to outperform Bitcoin here in the short term. And then when things maybe digest a little bit, but I structurally still like both of them and still see, more capital flowing into both asset classes as stores of value over time. So, but now we're in a bit of a vacuum here where vol can move quickly. Positioning is completely the other way. A lot of stuff that some of the options guys look at shows, very complacent markets, very complacent and positioning with respect to these systematic flows. And if we start to get a vol spike quickly, we could get a very significant risk off event within the next couple of weeks here. I'd be mindful of that before adding really any exposure to risk assets here in the coming days and weeks.
Yes, and the copper names are really overbought, up 61%, 65% year to date. So, but what's interesting, the copper names are making highs, and copper itself is still not. So I think it makes sense to move out of copper equities and into copper itself. One of the things we talked about in the book, How to Listen Markets Speak, we wrote the book in 2020, 21, or 22, and we talk about the power grid in the United States. We talk about artificial intelligence, right? We talk about this big move into copper to support artificial intelligence over the next 10 years, right? And we have a situation in Panama, Chile, and Peru where we just don't have enough copper projects that are coming online, right? We have a big problem with copper projects. Right now in Indonesia, we had a tragedy in recent weeks. So you're with the Freeport situation. And so this copper, we are heading for like a 1970s like OPEC crisis with copper. Coal names been hammered through the year, screaming by on this artificial intelligence trade. These coal names, if NVIDIA's CEO, the pump master himself, Jensen, is 50% correct about artificial intelligence and data centers, these coal stocks have to go up in my opinion, they have to go up 200, 300, 400%, because we need a lot more coal, we need a lot more natural gas, we need a lot more copper.
Yeah, clearly the bottleneck here for AI build out is this capex and infrastructure, and commodities are at the foreground of that, and it's just going to be about continuing to rotate capital, out of big tech into hard assets over time. You don't do it all in one shot. You don't do it all in 1 week, but you continue to reallocate, and particularly after these periods of overbought, you take some down, you move some capital around. It makes a lot of sense here. But again, I think next couple of weeks here could be a challenge if this vol story starts to accelerate from here. So definitely want to be mindful of watching some of those signals, before doing a whole lot.
Right, and that's the VIX once again. Market on Monday all-time highs with a 16 handle VIX. The VIX should be down by 12. When the market's at all-time highs, and that's telling you that it's October. People have gains to protect, and there's a lot of speculators buying calls. So that's what really helps vol, is when you have that fourth quarter with people. Say you're up 20%, you burn 1 or 2% on premium, buy some downside protection. That's what people do. But this time they have the speculators buying a lot of vol and chasing, buying breakouts. So that's what makes the risk reward. Our point the last couple of weeks, that's what makes the risk reward in getting long equity volatility very attractive. But anybody that wants to join us, Craig, your Discord room, you're running that with family offices, wealth managers around the world, do a phenomenal job there. You're coming out of a meeting, coming off an airplane, hop in the Discord room with Craig. It's info@thefairtrapsupport.com. Have a great weekend, buddy. Give my best to the family, and we'll catch up next week. Anything imparting to go?
No, sounds good. I think without the government data, we're going to be headline risk here now with Trump. It was a little bit out of left field. No one was really expecting it, right? And so when you don't know now what Trump is going to say or do, obviously he comes out with a fairly hawkish message here on a Friday afternoon, kind of changes the dynamics for how people are thinking about how people will be forced to think about hedging and for next week now. So the grind of just doing the same thing every day without any data That might change. We saw what that did at the end of March and the early part of April. So head on a swivel here.
Great. Well, thank you, Craig. The whole team in New York, Jose, Valentina, and the entire team, thanks for setting this up. We'll catch you next week.
Take care.
Thank you, Larry. Thank you, Greg. And thank you, everybody, for joining us another week on The Lens. So Larry and Craig spoke about our trade alerts. They spoke about our Discord chat and our Bloomberg chat. These are all available just for you. Our whole goal at the Bird Traps Report is to democratize information and make it as easy as possible for the retail investor. So if you're interested in joining us at any point, remember you can reach us at info@thebirdtrapsreport.com, and one of us will be happy to set you up. And as a friendly reminder, get your copy now on